Hi everybody, my name's Shannon Harding from Rock Solid Financial Services. Today I want to explain what bridging loans are, or also known as go-between loans. Only a lot of lenders I guess offer it, but they assess in very different ways, some easier, some harder. So bridging loans are for clients who are purchasing a new property who have not sold their existing property yet. It's an easy way for this scenario, for example, where you have the family home, okay, and you've got to wait during that time to get your new house built, which is a very big house. So during that stage, you don't know whether, people don't want to keep the house to invest. Also too, that they don't want to sell the house before they move into this, because obviously they've got a family to put a roof over their head. So this is not the other problem. This is not the only problem. The other problem is that assessing a client to have these two properties, which generally will go at very high figures. I've even seen go well over $1 million for both. Obviously the assessment's going to be pretty hard for the affordability. So how does this work, and how does it get assessed, and also what benefits will this offer? So a bridging loan, and just only a few can do this, can offer assessment on the end debt. So what I mean by the end debt is that once you've sold this property, after this is built and you moved in and everyone's happy, the funds and you got to I guess put in the scenario, and you've got to honour it obviously, that the funds and the profit that you have from selling your family home gets paid into this loan to bring it down. Okay. So in that case, in the scenario for a certain amount of lenders, they will assess you on the end debt. So the end debt of the amount that you're paying down this loan from the result of the sale. Now that's a lot easier than being assessed on, say, I'll use a scenario that of late of 400,000 than what it would be for these both combined, which was $1 million plus. So this here is obviously makes it a lot easier to service, and also too, it's a lot easier for the client as well. So there's a couple of offers or options. They can go on a repayment holiday while they're selling this and they live in there, in the new house, which accumulates interest, which is already calculated into this amount. Also, they can be assessed on interest-only repayments on the existing loan, on top of obviously this loan. Now, the key is, as mentioned before in the previous video, is to prevent paying LMI, or lender's mortgage insurance. So I prefer to, or with my clients, to have them sitting under 80% of LVR, which once again is explained in the previous video. Okay, there's a couple of options or offers. So with this kind of loan, we can go up to 85%. Not recommended, but can be done. We service on the end position or end debt. So service means what you're going to be assessed on, and also too, I already mentioned that there can be on offer with no payments in the go-between period, and also too, they'll give you 6 months generally to sell this property. So there's a couple of other things that can be on offer for a complex product like this. We can also offer offset accounts, which are hopefully get around to making another video on. And also too, there's fixed and variable rates on offer. Yeah, so that's pretty well it. The whole idea is to explain to you that there are other options and other loan products out there where you don't have to have service two existing loans and wait for one sold, and also to go through the stress of what are you going to do in between the build of this and moving from your home. Thanks very much for listening. My name's Shannon Harding, Rock Solid Financial Services. Feel free to give me a call on 0427 879 258.